the premise here was motivated by a conversation we had on this show with Chris Schindler a few months back, which I highly recommend that you go and listen to. The full thing is absolutely mind blowing, and there's 100 different amazing takeaways that would be accretive for most investors. But one of the things he mentioned was that there is a huge benefit in terms of total net returns to allocating to a multi-strat manager rather than allocating to many individual managers that each run their own independent strategy. And the benefits accrue from three different sources. The first source is that when you run a variety of strategies in a single fund, then a lot of the times the trades that you're putting on in order to execute on each of those strategies are orthogonal to one another, which means that often they will be netting, right? So one strategy will be going long a market and another strategy will be going short the market. And if you're running them in the same account or the same fund, you don't buy and then sell, you just net the exposure. So your average trading is a lot smaller than it would be if you were running them in separate accounts or in separate funds, right? And so you're paying less commission and you've got less trade slippage. The second is that you're paying performance fees, right? So a lot of the time, these are active strategies that have performance fees, and the performance fees you're paying are on two different things. One is the skill of the manager and one is the noise of the strategy. Well, when you combine a bunch of strategies together, a lot of the noise cancel out. So the noise term in that equation is much lower, and the proportion of the signal is much higher. So you end up paying a higher proportion of your performance fees on skill and a much lower proportion of the performance fees on noise. And so your aggregate total performance fees paid is a lot smaller when you mix all of these strategies in a single fund rather than when you have them across multiple different independent accounts or funds or strategies. And the third source is a little bit more nuanced, but consider a typical allocation to alternatives. Let's just say you've got 70% in a core portfolio. You're going to take 30% and allocate it, 30% of the portfolio of your capital and allocate it to alternatives. And let's say each of those alternatives each has a volatility of 10%. Well, when you allocate to a variety of these different alternatives, if they're uncorrelated, your total risk budget is substantially less than 10%, because when you combine all of these funds together that are uncorrelated, you get diversification and the total portfolio volatility goes down and your expected returns goes down commensurately. When you combine them all in a single portfolio, then if you don't re-leverage them, then the returns go down. But when you combine them, you can then rescale the total combined strategy back up to the original target risk, which means you're then getting a substantial boost to your target return or to your expected return. So the combination of those three different things in the case studies that we examined resulted in about a 50% boost to expected performance from allocating to a multi-strat fund or a multi-strat product rather than allocating to a series of individual products where each product is trading independently, paying fees independently, and you don't have the opportunity to rescale the total portfolio risk to achieve that potential target return. So that's coming out in the next few weeks.
Beautiful. Well, we took it from the beginning to the middle and left them on that star-spangled banner note right there at the end, leaving them, obviously with bated breath for the next papers that are coming out. And,
can I just say I'm actually really excited about that paper, Adam. I think this industry focuses far too much on the next source of alpha when stuff like that is a structural edge when you think about it correctly, and is an edge that cannot be diminished. Right? You either do it correctly or you do it incorrectly. And if you do it correctly, it's not something like crowding can get rid of. You are literally tilting all the odds in your favor. And I think that kind of stuff doesn't get enough play in this industry.
You know, it's really, it's so nuanced because we talked about this a lot internally because all of our strategies are massive multi-strats, right? And what that means is you are eliminating to the greatest extent possible the luck component, right? That noise component, which is maybe your strategy specification just happens to get really lucky in a year, right? And the vast majority of investors misperceive that luck as skill, and then your fund gets a massive amount of inflows, and it can make a career, right? Some really good luck that's 99% of the time just noise makes careers, right? And we have shorted that opportunity in order to be able to maximize the efficiency of portfolios. And so what it means is we expect to sort of be in the second quartile all the time and almost never in the first quartile because we just don't have that luck, that excess noise factor that gets you into the top quartile, right? The reality is funds that spend some time in the top quartile are a lot more likely to spend time in the bottom quartile, right? And it's that moving from top quartile to bottom quartile that ends up leaving investors with very mediocre returns over time. What you want is a fund that spends most of its time in the second quartile, never spends time in the bottom quartile, and that compounding effect ends up paying off to a massive amount of excess wealth over time. So anyways, it's a really interesting business decision, investment decision for an allocator. You got line item risk, you've got single custodian risk, single operations risk. There's all kinds of things to consider. But I think this is an important
did you touch on the actual manager turnover, right?